Have you ever thought about leveraging your home's equity to meet your financial needs? Let's explore the best second mortgage rates in 2023 to see if they can work for you. Second charge mortgage rates, known as second mortgages, can range anywhere from 2% to a whopping 20%. The best rate, of course, comes to those who can demonstrate their ability to repay the loan and have an excellent credit rating. But how do you secure the best rates and what are your options? Let's get into it. A second charge mortgage is a secured loan taken out against a property on which there's already an existing mortgage. This means that your home serves as collateral for the loan. Before jumping in, it's crucial to find out how much you can borrow and what it'll cost you without damaging your credit score. Now let's talk numbers. A good interest rate for a second charge mortgage lies somewhere between 2% and 7%. To secure this rate, you'll need to do some thorough research. This may involve using comparison websites or consulting with a mortgage broker. Just a friendly reminder, always opt for lenders that are authorised and regulated by the FCA, that's the Financial Conduct Authority. This makes sure that you're dealing with a legitimate and trustworthy lender. Also, be aware of potential additional fees when taking out a second charge mortgage, like arrangement, appraisal, and closing costs. Are you wondering how much you can borrow with a second charge mortgage? Well, the good news is these loans can provide a larger loan amount compared to other credit options. They're secured against your home's equity, which means that the equity in your home helps determine how much you can borrow. For instance, someone who's paid off most of the mortgage with 150 grand home equity may be able to get a loan of up to 120 grand. Remember though, that failing to keep up with your monthly repayments could lead to your home being repossessed. Now let's touch upon fixed versus variable second charge mortgage rates. Some products come with fixed interest, where the rate remains the same over time, while others come with variable interest where the rate changes based on the economy and the Bank of England's base rate. Second charge mortgage rates usually tend to be higher than the interest rate offered on your first mortgage. This is mainly because having a first charge means you have more debt, making you a greater lending risk. However, this rate will also be determined by your personal circumstances and, of course, your credit score. To find the best second mortgage rates, you need to do some meticulous research. The UK has a broad second charge mortgage market, with banks, building societies and mortgage specialists providing these types of secured loans. Comparison websites or a mortgage broker can be very helpful in your search, but remember, online tools like mortgage calculators are not always accurate, so take their results with a pinch of salt. Now let's talk about fees. Taking out a second charge mortgage can come with extra costs like arrangement fees, appraisal costs, closing costs, and potentially an early repayment fee if you decide to pay off your second charge earlier than agreed. Is a second mortgage cheaper? Well, it's not typically cheaper than a first mortgage. However, if your finances and credit history have improved dramatically, there's a chance you could get a better deal. Second mortgages can be an excellent idea for homeowners requiring large amounts of credit and seeking a competitive interest rate within the secured loan market. However, it's crucial to remember that not keeping up with repayments on your mortgage could potentially lead to repossession of your home. So it's all about responsible borrowing. While second mortgages can be an attractive option, they're not your only choice. Some alternatives to consider are home equity loans, home equity lines of credit, that's HELOC, taking a further advance on your existing mortgage, remortgaging and borrowing more from your equity, and generic secured loans. And if you don't need to borrow a significant amount, credit cards and unsecured loans could also be a viable option. Remember, the key to making the right financial decision is to gather as much information as possible. Consult a financial advisor, do all your research, and consider all the costs before making a decision. So in conclusion, second charge mortgages can be a valuable tool in your financial arsenal when used responsibly. They offer a way to borrow significant amounts at potentially lower interest rates than unsecured loans. However, as with any financial decision, it's essential to understand the full picture, including the potential risk before you go ahead. If you're interested in finding a loan for your circumstances, simply click the link below and fill out the short form. It contains a few questions like whether you're a homeowner and how much you'd like to borrow, and it'll give you access to quotes from around the UK tailored to your circumstances. It's totally free to do, and of course it won't affect your credit score, so click that link below, fill out the short form and give it a go.